Welcome everybody to this webinar brought to you by Bursa Malaysia. Allow me to just briefly share my screen. Okay, so today we are going to delve deeper into this title, this topic, how to avoid investing into overpriced stocks. So now, may I ask you these questions, ladies and gentlemen? Have you ever bought into a overpriced stocks, then only to see that the price keep coming down? If you do that, please type yes. Okay, let me know if you have ever done this mistake before. Okay, I've seen that many yes. Okay, now today we are going to discuss how can we avoid investing into overpriced stock, because sometimes, right, as human or as a human being, we like to chase highs, right? We see that stock prices go up, right, and then it has a higher probability of us making more money in an uptrend, and then we go in. We hope that we can make more money in this uprising trend, but only to realize that sometimes we are caught, okay, into a uptrending into a stock at a very high point before it really turn around and go down for a very prolonged period of time. So that how we got stuck in a stock. So today we are going to discuss more into how to avoid investing into overpriced stocks. So this webinar is brought to you by Bursa Malaysia and managed by LifeChamp. So before we go into the topic, so let's do a disclaimer. So whatever is shared on this webinar is only for educational purpose. In no way that I give any recommendation to buy or sell any company's shares. So if you decide to buy or sell anything, you do it at your own risk. All right. Now today we are invited content producer of kclau.com to share with you this topic. He himself is a fundamental investor, and he has written more than 100 articles on kclau.com. He is a regular webinar host and presenter. He's also a co-founder of dividendvault.com, in which they manufactured competent dividend investors who can build and manage their own dividend paying stock portfolios savvily and independently. Now, he himself is a dividend investor. He invests primarily for dividend income, averaging 4 to 8% in dividend yield per year. Okay, so ladies and gentlemen, that is Ian Tai. Over to you, Ian.
Hey bro, hey Shane. Hey guys, what's up, man? Once again, I would like to thank Bursa Malaysia for organizing this event. And of course, it's always a pleasure to do a show like this with Shane, our best buddy when it comes to talking about stocks at Bursa Malaysia. And of course, I've actually prepared a lot of stuff, so I'll just share my screen. Okay. All right. So are you guys looking at my screen right now?
Yes.
Okay, so with that, let's just continue. So basically, I mean to say, it's a Wednesday evening, and believe that most of you have just came back from work. So why don't we just do a few warm-up questions, all right, just to get your brains up and going. And yes, by the way, these slides, right, that I have actually prepared, they're not exactly completed, all right, because I need you to actually complete it with me. And as such, maybe I would suggest you to actually prepare your smartphone, your mobile phone, just put it beside you, because we need to actually do some computation, some calculation. And with that, we can actually complete the slides together. All right. So right now, let's move into the warm-up questions. And perhaps you can actually type in the chat box. And this is actually, there are two sessions to the warm-up sessions. And the first one will be as followed. Okay, so I just want to get to know you a little bit better. So maybe you can help me to actually answer the following 3 questions. I will show you how you can answer this, all right, shortly. But let me just read out the questions to you. So here we go. So question number 1, it's regarding about your last stock. So number 1, it's what is the last stock that you have purchased? Number 2, what was its stock price? And number 3, what was the PE ratio at that time? Okay, so if you can, so how to answer this question, right? Maybe you can type in the chat box in this format. Okay, so let's say, for example, what is the last stock that you have purchased? So if let's say you have purchased into Public Bank Berhad, then you just put a code there, PBB. And if let's say you have actually bought it at 13 ringgit and 57 cents, then you just put in RM 13.57. And if you kind of like remember what was the PE ratio at that time, let's say if you know, then just put in maybe 9.56, maybe 10, or maybe an amount. Or if let's say you couldn't remember at all, you just put that PE, don't know. And maybe Shane, we can from there receive and maybe get a response from the audience. So what do they say?
Let me check. Huh?
Yep.
Okay, we have Tong Guan 2 ringgit 50 cent, PE don't know. Astro 91 cent, PE is 9.27. We have BC Mall 22 cent, PE don't know. We have Top Glove, I believe, 6 ringgit, PE don't know. All right, we have Top Glove, PE 5 point, PE 8. Yeah, well, we have a whole list of companies. I can't finish reading them to you.
Oh, okay. So I'm
Yeah, many are still at Investor of Tenaga, Top Glove, among those lah. Okay, and we got one friend here, MSM. Wow, recently very hot at MSN.
MSM, huh? But here, what we can say is that we can see that a lot of people, they do not actually put in their PE. So it seems like either they put in PE, don't know, or they say, okay, some of them went as low as 5. Okay, because Top Glove, I mean to say, they have a very high EPS, earnings per share for 2020. So I believe that the PE ratio will be below 10, all right, because there's such
Yeah,
a
but I
high.
think PE don't know maybe two reasons. Number one is maybe the earnings is negative, so there's unknown PE. Or number two is they never study the PE ratio when they invest.
I believe most do not study the PE ratio because most of the companies, I'm actually looking at the list right now, most of the companies that they bought are actually, they have positive EPS. It's just that most people don't actually calculate the PE ratio lah. All right. Of course, there's one very unique one, Pfizer. So Nicholas actually bought Pfizer, PE is 20.71. Okay, so that's the more memorable one. Zachariah in nature. Oh, okay. PE ratio 21. Okay, so we have a lot of a bunch of PE ratio, a bunch of answers. So thank you so much for your response. And now I'm going to move on to the second session of the warm-up questions. So which consists of question 4 and question 5. Okay, so question 4 and question 5, right? It's about this. Okay, just now you have talked about the stock, what you have bought, the price, and the PE ratio. So the next question is this. What is your intended holding period for this stock, for the stock that you have just mentioned, and put it in the chat box? And the fifth one will be, what would you do if the stock price that, if the price of the stock that you bought has fallen like 20% from your buy price? Okay, so here's how you can answer. So here's how you can answer the question 4 and 5. So if let's say if you are, you just want to hold it for 1 day, then just put 1D, 1 week, 1W, 1 month, 1M. You can put there 1 year, 5 years, 10 years, or forever. Okay, so that is for question number 4 and question number 5. What will you do if you falls 20% below your buy price? If you say you want to buy more, just put buy. If you want to say you just hold, then you hold. If you want to sell, sell. So Shane, what are the responses from the floor?
Okay, there are many responses coming in. Okay, some say 5 years, 5 months, 1 year, 1 month, 2 years, forever. Wow, I really respect people who put forever. Okay, Grace put it very interesting, until it hits TP.
I see.
Yeah.
Okay lah.
I think majority put 1 year lah. Okay.
Yeah, I believe so lah. I mean to say for those people who put in forever or anything beyond 5 years, 5 years, 10 years, and forever, right? And maybe they put a buy or hold, right? I think maybe you are, you may have actually found yourself coming to the right spot in the right. You are probably what we share the similarity traits when it comes to this, and perhaps you're in the right place lah. All right, but if you are, let's say, in the one day category, 1 week, 1 month, few months category, of course, I suppose maybe that one is more into trading. All right, maybe you're into short-term gains and stuff like that. All right, so which I personally do not know how to do lah. All right, because I'm not a short-term trader myself. Okay, but anyway, I mean to say it's good to have you also on board so that we can actually exchange ideas. Maybe you can pick my brains and you can actually understand from my point of view how do I see things when it comes to stock investing. All right, so thank you so much. I mean to say it is a great pleasure to to get to know you better. Okay, so now I mean to say the 5 questions is just to get to know you. So now it's maybe I'll spend a little bit of time for you guys to actually get to know me a little bit better. So I believe that the 5 questions, right, these are very vital questions because they kind of like reflect on the objective of why we actually open a brokerage account and start buying stocks or selling stocks. Okay, so the objective is actually very important. And for myself, okay, so I'm a dividend investor. That's usually I will call myself, simply because in fact, all the stocks that I bought, right, they are dividend paying stocks. So therefore, these are the similarity traits that actually unites all of my stocks in my portfolio. And my objective is actually shown on the screen. So I love to actually build a portfolio where I will love it if I can grow my dividend income from time to time. From every single year, I should actually get incremental dividend income. So that is my primary objective. So I wasn't into short-term profits or some durian runto, right? That kind of gains. These are I mean to say occasionally I have them, but then it's not something that I would depend for my portfolio. Okay, so dividends, especially when it comes in, perhaps I would say in 12 months, right? If 1 year we have 12 months, usually 8 or 9 out of these months, right, I will actually receive dividends. And yes, by the way, of course, if you have any questions along the way during this webinar, just put it in the Q&A box. I'm sure Shane and I will actually be happy to monitor them after this webinar. Okay, so this is my objective. I build a portfolio to grow my dividend income. So the question is this, so if that is my objective, right, I would love to ask myself this question. So how do I build a portfolio where the stock that I buy, right, can pay growing dividends consistently? So the keywords here are very simple: growing dividends. Okay, so maybe if you want to participate and answer, right, you can actually type in the chat box. So how does a stock pay growing dividends consistently? So anyone commented anything in the chat box? No?
Not yet.
Not yet. Okay. So basically is that, I mean to say, maybe we have one, maybe we have a few. So, okay, so I can see here there are, revenue, it has to grow from earnings, free cash flow, revenues, EPS, dividend policy, value investing, if the business grows, etc., etc. Yeah, so these are actually pretty so I mean to say most of us are actually pretty logical in that sense. All right, so it's all about the business performance. Okay, so if the business can grow its sales, the business can grow its profits. If the business has cash flow, then of course the stock can continuously pay out growing amount of dividends. All right, so that is actually pretty logical, the answer. And the answer is actually shown on the screen. So the key thing here to actually fulfill my objective is very simple. It is to find stocks that actually deliver consistent growth in profits, and they must be consistently bringing in positive operating cash flow. And if you have these two combined, then I can actually say that this is a stock that I will look into in order to grow my dividend income consistently. So the key word here is about consistency. So which means to say I view this word like it's actually one of the most important vocabs. All right, the most important vocab when it comes to my journey as a stock investor. It is about consistency. Okay, so this is the word that I tend to focus a lot, not just for my own portfolio, but whatever I do is about consistency. Okay, so let's actually move on. So now the question is this. So let's talk about consistency a bit. So the question is that, how do I measure consistency? All right. And here, right, I'm going to just share with you two simple graphs. All right. So maybe, okay, just before I move on, I just want to ask, how many of you here, you have actually attended my previous webinar sessions? Maybe, just a few weeks back, you have actually attended the session, or maybe, let's say if today is your first time, right, maybe you can put in the chat box. Are you a first timer listening to my presentation, or you have been listening to my presentation at Bursa Malaysia for quite a number of times already? Just put it in the chat box. So Shane, what do I get? Wow, a lot of
Majority is first time.
first timer. Right, okay, only Marcus Chan few times. Jennifer Tian, second time. Oh, welcome. Nazrul's few times. All right. Yongjia Chan, a few times with you. Okay, Hua Pong, second time. Okay, there. So mostly first timers. Okay, and the majority rest is actually second time. All right, so thank you so much for your response. Okay, so I'm going to just show you two simple graphs, because this is what I would like to do. I like to, for those of you who have been following, when it comes to stocks, right, I will tend to look at profits and cash flow. And the thing that I like to do before I invest is to plot graphs like this, okay? So I'm going to show you two simple chart that talks about profits. And you can actually tell me which of these two are consistent when it comes to delivering growth in profits, okay? So let's take a look. So this is stock A. So these are real companies which are listed on Bursa Malaysia. And as you can see, stock A, shareholders' earnings, and I have compiled their data from their annual reports from 2009 to 2020. So this is chart A. These are exact figures. And this is stock B, okay? So stock B looks something like this. So once again, this is stock A, and this is stock B's. So these are the two companies where I have plotted the graph of shareholders' earnings. So which of the two do you think has fulfilled my criteria, will actually appeal to me as a stock that is very consistent? So of course the answer is stock A, right? Yeah, I can see that there are a lot of you putting in stock A. Yes, okay, so the answer is actually quite obvious, it's stock A. So you can see that the way I invest, right, for all of my portfolio, okay, except for a few lah, all right, except for maybe one or, I wouldn't say except for one or two, I would say all of it lah. If you want to measure it based on pre-COVID-19 era, right, pre-COVID-19, all of my stocks all look like this, okay, when it comes to shareholders' earnings. It will look something like this or close to this, all right, and that's the only thing that I will put into my own portfolio. I will put in all this kind of, there's only one way when it comes to earnings. It's only the up way. There's no other way when it comes to my portfolio. So for example, for stock B, right, as you can see here, we have a jump, a surge when it comes to earnings in 2011 and 2016. So I don't go for all these kind of stocks whereby suddenly out of nowhere, all right, out of nowhere they have a surge in earnings and then suddenly it doesn't, deliver. It didn't actually sustain its earnings growth the subsequent few years. So these are stuff that I won't actually get myself into lah. All right, and so with that, right, it's only stock A that I will put in. Stock B, I will tend not to actually I won't have anything to do with stock B lah, to be honest. Okay. So now back to my objective. Okay, back to the objective. So my objective is to build a portfolio whereby I love to actually see my portfolio, from my portfolio, I can earn incremental dividend income. So therefore, I will actually focus my own stock. All right, I will actually focus on finding stocks like stock A because I'm actually looking for consistency. Okay, so that is actually the objective. Now, of course, this webinar is about price. Okay, how do you avoid buying into overpriced stock? But the key thing here is that before we actually look into the price, personally, I will actually find stocks like stock A first. All right, then I'll put it into the watch list, and then we only talk about the price, because to me, price is not the most important thing when it comes to investing in the stock. To me, it's the business model. To me, it's the profits, the cash flow, the future plans of the company. All these things are very important to me as an investor because I'm actually looking for consistency. All right. So with that also, I would also like to, share with you a food for thought. All right. Maybe you can actually take some time to actually ponder about it. So the question is this. Just now I've shown you stock A and stock B, right? So the thing is that if let's say you want to value stock B, and stock B is actually not the kind of stock that I will personally like, then what's the point of valuing the stock anyway in the first place? Okay. So the question is this: what is the purpose of valuing a stock if you do not wish to keep it in the first place? So which means to say, if there is a stock and the earnings are not so consistent or it's actually making a loss, for me personally, I won't actually want to keep it in my portfolio. So therefore, whatever price you give me, right, it doesn't matter whether it's 10 cents, $1, $10, or $100, right? If that thing is not my thing, we can actually kind of like forget about it lah. All right, so that is actually my viewpoint of investing in the stock market. It's about finding what you want first, the type of stocks that you want to actually invest into first. Then only we talk about the price. And now let's take a look at the art of valuation. Okay, so over here, I believe that maybe you get to know me a little bit better. So now the question is this. Okay, now I'm going to re-ask you this question. So what is your priority like when it comes to buying a stock? Okay, so maybe you can type in the chat box. On your left, is it that you will be more price sensitive first, which means to say the stock price is of greater importance to you? That means to say stock price is more important, then the business is actually quite secondary? Or is it number two? Is it number one, the business model first, and then we only talk about the stock price? So maybe you can actually share your views on the chat box. Maybe Shane, you can actually share what the people say.
There are a mix of answers,
huh?
Yeah, I think majority is more inclined to picking business first before price.
Business first before price, huh? So I believe that,
so you have built a right tribe,
I hope so lah. I hope we.
But majority of people I met is always the stock price first.
Actually, I mean to say right now we are now at coming to the 9 p.m. mark. Okay. So just now we talked about the first 5 questions, right? The warm-up questions, right? So what's the stock price? So what's the stock that you buy? What's the price? And then what's PE? And then we talk about, and then all this kind of stuff. So it seems that a lot of, I mean to say, I can get a feel that a lot of people are still, on the left box, maybe it's the stock price, because people tend to remember the stock price. People do not, you ask them, oh, what PE? Oh, don't know what PE there. All right. So there are quite a number of listeners out there who remember on the stock price, but they forgot about the PE ratio. So I kind of like know, okay, maybe they are in the first category, which is the left category. But now hopefully that if you are looking into the art of investing, right, then I believe that you should be switching gear towards the right box, which is you should actually look, investors, right? I won't tell you what to do lah, but for investors, they will tend to focus on the business first, then only we talk about the stock price. But if today you say, Ian, I'm actually a trader, I just want to do some momentum trading, swing trading, day trading, and kind of stuff, right? Then of course you can actually remain at the left box, which is, you dabble around with the stock price and you have nothing to do, because for traders, they don't really give much. They're not really too concerned about the business. It's only the investors who like to keep and invest and accumulate shares of good companies. All right. So for me, I'm like you. I mean to say I'm on the right hand side. The business comes first, then only the stock price. Okay. And basically, right, after I look into a company, if I like the company so much, then I will go through a process where I'm gonna value a stock based on these 3 valuation ratios. Okay. So the 3 valuation ratios are PE ratio, PB ratio, and dividend yields. Okay, it sounds very simple. PE, PB, dividend yield. But for me, right, the art, so it's that simple. It's just that 3. But the thing is that I kind of like practice it on a daily basis for many stocks, and from there, right, it has become an art to actually interpret the figures behind all these valuation ratios. Just treat it like just treat it like martial arts. Okay, there are different types of martial arts in the world today. There are Chinese Kung Fu, there are like Shaolin Kung Fu and stuff like that. But I do not know anything about any Chinese martial arts. But practicing the 3 valuation ratios, right, it's a bit like westernized boxing. All right. Why do I say so? This is because, right, in, let's say, English boxing, all they do is, most of the time, correct me if I'm wrong, they only practice 3. There are only 3 variations of fists, all right, or punches. All right, so you have the straight punch, which is the jab and cross, and then you have the uppercut, and then you have the hook. Okay, so it's just these 3. All right, jab and cross, uppercut, and hook. And these boxers, right, they will just practice these 3 different types of punches on the back, on the sandbag, or on the speed bag and stuff like that, countless of times. Every day they just do the same old routine. There's not much of a variations to actually practice. For westernized boxing, it's just these 3. After they have practiced these 3, they practice the footwork, and they improve on their stamina, on their physique, then they are ready for fight. Okay, so practicing the 3 valuation ratios is a bit like westernized boxing. That's simple. Okay, so with that, right, I'm going to just go through a practice session with you to actually calculate the PE ratio, the PB ratio, and dividend yields. And by the way, and with that, I'm going to look into an example, a real case study, in fact. So this is actually from a real public listed company in Malaysia. I won't name what company is that, but these are the items, these are the stuff, the real data that I actually collected from the annual report. And we have been given 5 different things. Number 1 is the shareholders' earnings. Number 2 is the shareholders' equity. Number 3 is the dividends paid for 2020. And number 4, we have the number of shares issued. And finally, number 5, we have the stock price as of 23rd of March 2021, which is at 1588. So now the task is very simple for all of us. Just practice this with me. So we are going to calculate for Eberhard what is its PE ratio, PB ratio, and dividend yields at the time of 23rd of March 2021. Okay, so how do we go about it? So with that, let's start off with PE ratio. So PE ratio is very simple. So P stands for price and E stands for earnings. Okay, so this ratio suggests that, if a company does not have earnings, that means you can't calculate PE ratio, because you need a company to have earnings before you can calculate its PE ratio. So if a company doesn't have E, most likely it won't appear in my own portfolio, okay? Because I don't like companies that have no earnings at all. Got P, no E, no good. Got P, got E, okay, let's calculate, all right? So the way to calculate, right, is very simple. first we need to actually calculate the earnings per share. So how do we calculate the earnings per share of A Berhad? Is actually very simple. So you just take, let's say the shareholders' earnings, which is 59.9 million ringgit, as shown on the screen. You divide it with 60.8 million shares. Okay, so you take the full, so you take shareholders' earnings, you divide it by the number of shares issued, and you will get the earnings per share. So perhaps you can do the same calculation with me, and from there, maybe you can type in the chat box what do you actually get? What is the answer that you get from this calculation? So Shane, perhaps you can actually share with us what is the response from the floor.
$0.985 is the first answer that I got.
Yeah, 0.985.
Sharon?
Correct. Okay, so the answer is 0.85.
I also got a few put 16.12.
16.12. Okay, so I think, of course, we have to follow the order of the presentation. All right,
Yeah.
I believe the 16.12 is simply
It's a
because
PE.
jump the gun.
16.12 is a PE.
But don't worry, I'm assuming that all of us are actually, we are going real slow, a little bit slow over here. So the thing here is that, yes, we got earnings per share, which is 0.985. And from there, now we can actually calculate the PE ratio. So the PE ratio, right, is you take the price, which is 15.88, and then you divide it by 0.985. Then obviously you get a PE ratio of 16.12. Okay, so very good. I believe that most of you are quite, you have already come into this webinar with the knowledge of PE ratio. So the question is PE ratio of 16.12, right, a good deal to buy A Berhad? So what's the answer? What's your response like? So how many people have actually responded? How many of you think that 16.12 is a decent deal, a good price to come into? That means you'll say, okay, 16.12 is good, so I'm gonna buy it at 15.88. So what's the response from the floor?
Some say yes, some say good, some say don't know. Need to check with the peers, need to check with the historical data, need to depend on industry. These are some of the answers.
Okay, actually, there's one of you guys, right? Actually, it seems that you have actually attended my show, because the answer the answer is actually I believe that it is actually reflected through your answer. Okay, for some of you guys who say yes, all right, then you may want to listen further. Okay, so the answer is actually, the better answer is actually don't know. All right, because you can't tell whether or not a stock is good at 16.12 unless you have something to compare. All right, unless you have something to compare, then only we can talk about whether this stock at 16.12 is a good deal or not. All right. So for those of you who say don't know, right, congratulations. You actually got the right answer. And with that, let's move on to the next one, which is this. Okay. So just now when I talk about comparison, right? So as you can see on the screen, okay, you need something to compare to. So for A Berhad, right, I have computed the PE ratio, and the PE ratio looks something like this. Okay. So it is so for the past 10 years, and this is what I do, by the way. I love to plot graphs like this, and after that, I tend to actually compute the following. I'll tend to find out the lowest PE ratio out of that 10 years period. I will also want to find out what is the highest PE ratio, and then from there, I also find what is the average PE ratio, all right, during the 10 years period, and from there, I will just compare the current PE ratio with the long-term average. Okay, so now the low is 9.3, average is 14.88, high is 24.11, and the current PE ratio is 16.12. All right, guys. So is stock A at the PE ratio of 16.12 a good deal? Maybe you can put it in the chat box. And Shane, perhaps you can actually tell us.
some say fair, some say average, some say good, some say no.
Okay, how many? Okay,
I
what's
would say majority will be more inclined to fair and no. Average, fair, average, not really.
fair and no? Okay, so basically, I believe that most of our audience here are actually getting the message here. All right. So some of you guys say fair. I believe it's simply because it's actually very close to the average PE ratio of 14.88. Some say no because 16.12 is still above the average PE of 14.88, right? So as an investor, right, like myself, I also tend to say that whatever you buy, whether it's stocks or property, you kind of like want to actually buy it below market average or below average price. So the thing is that if you know that the mean or the average is 14.88, try lah to actually. How many of you prefer to buy stock A at the PE ratio of below 14.88? Let's say around 12. How many of you will prefer that over 16.12? Now,
Yeah.
most of you guys say yeah, yes.
Me.
Okay, so that is actually the whole game plan. You see, I mean to say it's a whole game plan. The whole system is that you guys, I mean myself included, I also want to buy a stock. If let's say the price, if the price is below average, below 14.88, okay.
But
So
I want to highlight one thing, which is
yep.
of course we all like to buy stocks when it is below its average PE, but usually when a stock goes below the average PE, it is during a downtrend, and most people will say that no, I like to buy stock at below its average PE, but then when they bought it below average PE, then because it's a downtrend and stock price still go even lower, and then they cannot see through, and then decided to cut loss when only to see a rebound. Now you always have. I think it happens to many people. I've seen it before.
Hmm. Yes, of course. And I mean to say in this line of education, we can see actually that happening lah. All right. Of course, there are a few observations from that. Number one is that investment has a lot to do with emotional intelligence lah. All right, meaning to say, that's why it's a lot of questioning yourself, like self-reflection, like why do I buy this stock in the first place? Okay, what do I want to gain out of it, or what is the reason why I will forego my money and go and put this money into that stock? Okay, so that is actually a process of self-reflection along the way. So that is actually number one. Number two is that okay, a lot of people tend not to buy stocks when the PE ratio is actually at the low side, simply because a lot of people think that something must be something wrong, but if let's say the PE ratio is actually very, very, very low. Okay, and with that, right, actually, I mean to say that's why I also do not know how to comment on this lah. Okay, why feel that way? But yet these are people who actually buy stocks at the highest PE ratio possible. Okay, because they feel that if the stock price is going up, something must be very right about the stock. If the stock price is going down, something is very wrong with the stock. Then of course, then you won't do this exercise lah. But here, this webinar is actually, the reason for it is because it's to share an idea. All right, is to share an idea, is to actually bring you guys into, let's say, the mindset of an investor. Why actually we do things a little bit differently from the rest of the pack, and with that, how come? And then from there we get some profits lah. All right, so this is just just a hindsight to actually let you know about these things. Of course, you guys got all the questions. I would love to answer them. Just make sure you put it, like some of you asked about Top Glove and all this kind of stuff, right? Top Glove tech stocks, right? Just put it in the Q&A box. Later I'll go and answer that lah. All right. After I've team all the session, all right, counting all the educational materials. All right. So the key, so I believe that majority of you are now getting the picture. It's about buying the stock at below average PE. All right. So the aim here is to go below 14.88. So 16.12 is like kind of like above average lah. So it's like, if you ask me, tak sedap hati lah, tak sedap hati kalau saya beli kat 16.12. All right. Of course, try to get it below 14.88. Now let's move on quickly to the PB ratio. So PB, price, so P stands for price, B stands for book value. Okay, so in order to calculate the book value, right, let's do this exercise very quickly. So the way to calculate book value, or I would love to call it net assets a share, is to take the shareholders' equity of a company like Eberhard, 495.7 million ringgit, and you divide it with its current number of shares issued, which is 60.8 million. So what's the answer? I mean, let's do the maths really quickly. So Shane, any response from our audience?
All right, we got the first response, which is 8.15.
8.15. Okay, nice. 8.15. Stock price is 15.88. So now you got the B, which is 8.15 book value or net assets a share. So the PB ratio as at 23rd of March 2021. All right.
Okay, so what is the PB ratio?
So it's PB. So we take
1.95.
Yeah, we take 15.88 divided by 8.15. So you get 1.95, right? All right. So I believe that most of you get the computations right. Let me just double check with you from the chat box. Yes, I believe that most of you are following the whole lesson series. Very good. All right. And now the same thing. Okay. I will actually go and go through the whole stock charting. I wouldn't say stock charting because there's no price chart. I'm just going to plot the PB ratio graph for the past 10 years. And again, I'm going to compare the low, the average, and the high, and compare it with the current. So just now we have calculated that the current PB ratio is 1.95. And how do I say? So where does it stand? So is it below average or is it above average? It's above average, right? So it's above 1.66. All right. So the question is this a good deal? So how many of you say it's a good deal? Same. No. Okay. No. All right. So yes. So the answer is actually not really, because tak sedap hati lah. All right. Because the whole main purpose is to actually buy below 1.66. All right. So that's why if you get it at 1.9, it's like, not nice leh. All right. Because other people get it cheaper than you. So the feeling is not right. And
so for you personally won't you won't invest even though the PE, when the PE is above the average and the PB is above average, so you won't
I prefer not lah. Okay, so that's why the thing is that I mean, unless there's other pulling factor lah, unless there's something that attracted me lah, or I terpukau or what lah, I do not know. But then, okay, logically speaking, no, I won't do it lah. Okay, the general answer is no. And finally, let's go through this dividend yield formula. So as you can see, there's a typo over here. And I'm going to change this to dividend. So dividends paid for 2020 is 30 million. So let's calculate the ordinary dividends per share. So what you guys get. So dividends per share is calculated as followed. You take 30 million divided by 60.8. So what would you get? Any response from the audience?
3.1%. Okay, 0.49 and 3.1%.
0.49. Yep, so okay, let me just put in 0.49. 0.493. And to calculate dividend yields, right, what you need to do is that you take the ordinary dividends per share. All right, as you can see, I highlight here the word ordinary because sometimes a company can put in special dividends. I tend to exclude special dividends if it's not regular lah. All right, if it's just a one-off thing, I will just put it away because I want to know consistency. So it's always about the ordinary dividends per share. So you take ordinary dividend per share, which is 49.3 cents. You divide by 15.88, and there you go. You will have a current dividend yield of 3.10%. Okay, 3.10%. And with that, I'm going to just I have actually plotted a dividend yield graph for stock A. And as you can see, the low is 2.09%, average is 3.44, high is 4.36. So good deal, bad deal? What do you say, guys? Okay. Oh, one of you say good. Okay. Okay, bad deal. Some of you good, bad, no, bad, bad. Not so good. No good, right? Yep. Okay. So all right, there's just a couple of you guys who say no good. No, there's just a couple of you who says good. Most of you says no good. I myself would say not too good. Okay, because I'm a dividend investor. All right. So logically speaking, right, I should aim to actually buy stock A above 3.44%. If that is the average, I should get above average dividend yield. So I should aim something like, beyond 3%, like maybe close to 4%, 4.1, 4.2. That would be good. All right, but what we have calculated just now, this stock at as it stands is giving out 3.1%, which is in between low and average. So it's kind of like below average. All right, so since it's actually below average, therefore it is actually not quite a good deal lah. All right, so I'm with the pack who actually says that this is actually not really a good deal. Okay, so the question is this. All right, so we have gone through the PE ratio, the PB ratio, and the dividend yield. And now let's look into the conclusion. Should I invest into Aberhart? Okay, so I prepared 3 simple questions that may actually, it has guided me. I hope that it will guide you in your decision-making process. So the question is this: number 1, is Aberhart the kind of business that I want to keep for the long term? All right. There's other webinars I believe that we can do about business models, financial ratios, and all this kind of stuff, but it's not for today. Today is about valuation. Today is about price. So let's assume that Aberhart is the kind of business that I want to keep for the long term. Okay. Otherwise, if let's say I do not want to hold it for 10 years, I'll probably say, you know what, this is not the thing that I want to keep, and I will forgo it. So so let's just assume that Aberhart is the kind of business that I want to keep for forever. All right. And let's move on to question number 2. So question number 2, as you can see, I have done the valuation ratios. I have the PE, PB, and dividend yield. And I have the 10-year low, the 10-year average, and as well as the 10-year high. So I'm going to just put in the current. Okay. So let me just backtrack my slides. So the current PE ratio as at 23rd of March, 2021 for Aberhart is 16.12. So it's 16.12. PB, let's see, PB is 1.95. PB is 1.95. And dividend yield is 3.10%. So it's 3.10%. So what do we get from this table? So the table here, it says the current PE ratio is higher than its long-term average. The PB ratio is higher than its long-term average. The dividend yield is below its long-term average. So therefore, not too good lah, okay? Of course, because there's a part of me that wants to beat the long-term average. So therefore, if it doesn't beat the long-term average, I will probably prefer another stock who has actually beat the long-term average. Okay, so that's my way of doing it lah. But let's say the current PE ratio is below the long-term average. The PB also is below the long-term average, and the dividend yield is above the long-term average. All right. So will I buy? That leads us to our third and final question. Okay. So the third and final question is this. I would say the question is this: are there better stocks or better businesses out there in the stock market? You see, in Bersam Malaysia, we have 900 companies listed. All right, there's a lot for you to choose. So the question is this: are there better stocks or businesses in that 900 companies, right? They are offering, where the prices are offered at more attractive valuation ratios than stock A. Okay, so here's what I do. So let's say the A Berhad is at the PE ratio at 16. I will gather similar businesses with similar financial performance. You know, the earnings growth has been very good. And I put them A Berhad, B Berhad, C Berhad. And A, B, C Berhad, let's say PE ratio is about 15 to 20. Dividend yield is about 3 to 4%. All right. So from this three, right, then I will see which of these three is really, really the one that I want to keep. Okay. So that is my thought process when it comes to buying a stock. And of course, if let's say capital is if I have more capital, then if I have more capital, what I will do is that maybe I will put some money in A or B, or maybe A, B, C. All right, as long as these businesses are the type of businesses that I really, really want to keep. All right. So in summary, I will leave you with these pointers. Number one is this. Okay, identify your investment objectives. So mine is dead simple. It's about consistent growth in dividend income. Simple. Number two, in order to get dividend growth, I will actually look into profits and cash flow. So these two are very important to me, and I have a vocab, and for me the most important vocab is consistency. So that is very important in my vocab. If let's say the company is not consistent in profits and cash flow delivery, that is usually the stock that I will avoid investing into. Third one, I will calculate the current valuation ratios. The fourth one, I will compare them with the past valuation ratios. And finally, I will compare the stock with other stocks to make the final decision. And that is my thought process from the objective to selecting the stocks, and finally down to assessing the price, and the final part, which is to do some comparison with other stocks in order to make the best decision for myself. Hope that whatever I presented today is actually helpful to you, and maybe it can guide you to make better and more well-informed decision in your journey of picking your next stock or investing in your next stock to build your ideal portfolio. So with that, I'm gonna pass the control back to Shane, my brother. So Shane, all back to you, man.
Thank you very much, Ian. Can you click the next slide for me, please?
Oh.
All right, good. Thank you, slide. All right, thank you very much, Ian, for your wonderful sharing on this, how to avoid investing in overpriced stocks. And today, I think the session is very useful for us, especially for those beginners who want to learn how to value stocks. And we learned from Ian about comparing the valuation of a stock over a 10 years period to assess whether at the point of investment, are we actually purchasing the companies at a above average valuation over the past 10 years or below the average valuation for the past 10 years in the point of the price to earnings perspective, price to book perspective, as well as the dividend yield perspective. All right. So thanks, Ian, for the insight into how you pick stocks and make sure that you avoided all the, expensive stocks, overpriced stocks. So, and thanks all of you for showing up for this webinar. If you have any questions to ask Ian, you may put in the Q&A box, then we will address them accordingly. But because we have a few hundred of you online, so we might not be able to ask all question, huh? For those people who are asking questions on, a chat group, please type your questions in the Q&A, so it's easier for us to manage. So if any question to ask Ian, type in the Q&A so we can easily manage it. If you put in a chat group,